thank you for joining us for our Pengana Private Equity Trust webinar. My name is Melissa Raylander, and I'm the Queensland Distribution Manager for Pengana. Today, I'm joined by Fred Pollock, who is the CIO of GCM Grosvenor and the Lead Portfolio Manager for PE1. Before I hand over to Fred, just a couple of housekeeping. The presentation will run for about 15-20 minutes, and then we will have time for Q&A at the end. If you do have any questions, just please pop them in your Q&A box at the bottom of your screen. I also want to touch on something that's likely front of mind for a lot of our PE1 investors, and that is a discount that we're seeing to the net asset value presently. As part of the distribution and marketing team, I can assure you that this is a top priority for Pengana, and we're out there talking about PE1 on a regular basis. I can confirm there's a lot of interest from clients, and we've had some great conversations. But unfortunately, we haven't been able to drum up enough on the buy side to get that on-screen buying to close a discount just yet. And I'll touch on why we think that is in just a moment. Before I do this, I did just want to point out a bit of a refresh on PE1. When we launched in 2019, we wanted to offer a top quality private equity portfolio run by a best-in-class manager to retail Australian clients. But we wanted to offer them liquidity and income. The point of this was to give clients the flexibility to allocate to an instantly invested portfolio and rebalance as needed. We have in terms of a portfolio, if you're holding private equity for a private equity timeframe, which is around an 8 to 10 year period, it has historically delivered strong risk-adjusted returns at a portfolio level. And we have full confidence that PE1 will deliver a great outcome for investors over the long term. As you'll hear from Fred, the portfolio has actually outperformed over recent years. In relation to the reason why we're seeing a discount to NAV, we can make some inferences. Firstly, at a market level, we have seen that the LIT and LIC market has been trading at a discount since about 2022. And this is even for those investments that typically trade at a premium. We're not making excuses for that, but we do think that that market dynamic is impacting PE1. A second note is PE1 is quite a small vehicle in nature, and it can get swept up in market volatility. A more specific reason we think we're seeing a discount in PE1 is because after a very successful launch, we have seen the NAV trade sideways for quite some time. And we think this has kept a lot of buyers on the sideline. In terms of thinking about an overall portfolio, this is quite natural for private equity to behave in that way. At Pengana, we take it seriously, and we do want to spend time to try and close this discount over time. We have tried various methods to address the selling. We have bought units on our own balance sheet, and we have used a buyback mechanism which has been accretive to shareholders. In terms of buybacks, we do have the ability to perform them again in the future, but we do have to balance making sure that the vehicle doesn't shrink too much, because that will impact the trading. We have confidence that over the long term, as the portfolio increases month on month, buyer interest will resume and people will get back into buying PE1, and we hope to close the discount. In the meantime, we see exceptional value at current levels, and I can tell you that a number of the team are actually buying PE1 currently. I think you're going to find Fred's update insightful and hopefully reassuring, and maybe you'll see why we are so optimistic about the vehicle. He's going to provide an update on the overall market, dive into the portfolio, and explain why we believe recent headwinds are going to turn into tailwinds going forward. With that, over to you, Fred.
Hello, everybody. If we could go to the first slide on the market update. So maybe the first thing I'm going to touch on just the backdrop in the markets as well as private equity. And then, as Mel said, I'll get into the portfolio a little bit, talk about some of the kind of key positions, some of the places where marginal investment dollars are going, and then we'll leave time for questions at the end. So I'm not going to kind of belabor each slide. The general market conditions, I think that everyone knows, if you go back to the trust launch in 2019, rates were zero. You obviously had the COVID period. You had significant inflation globally, kind of every market, the US, Europe, Australia, everywhere. As a result, you had an increase in interest rates. I think the US and the UK were probably at the forefront of raising rates. The US base rate got up to 5 to 5.5% over that period of time. It had a negative impact on private equity, obviously, and I'll talk about that a little bit in terms of if you raise the cost of financing, that will lower the value of the companies. You saw multiples during this period change dramatically. I'll speak about that a little bit too, which is part of the explanation for why the NAV has gone sideways the last 2 years. The good news is that the economy has been pretty good. The companies have continued to perform. Cash flow in the underlying enterprises has compounded at almost 10% per annum during that period. And so it largely offset the contraction in multiples. What's happened in recent days, and I think everyone would have seen, the Fed has started to cut rates and it's already made a move. I think it's referenced on this slide is expected in September. That's happened now. There's a 50 basis point cut in rates. The markets are forecasting a fairly significant decline in interest rates in the United States. The 10-year, which peaked at about 5.2%, is now trading at about 3.6, 3.7%. So there's an expectation for interest rates not to return to zero. I think that period and sort of the experiments around zero interest rates globally are probably in the past, but to return to a more middling level, which is historically normal, which is 50 or 100 basis points above inflation. Right now, inflation in the US is 2.5%. So the market is pricing in interest rates to be about 3.5% on a go-forward basis. If you looked at the cost of financing, that means the cost of financing during the peak in 2021 was probably 5 or 6%. It got up to 10 or 11% during the kind of late 2022 and 23 period. And now it's back down to sort of a middling 7 or 8%, which I'll talk about later. It's kind of good news overall. If we could go to the next slide. Here's just the graphic with inflation coming down. You can kind of see on the left-hand side what I was talking about in terms of the inflation spike, forward expectations for inflation. We're still not back to 2%. And so I think that's a big deal. There's been a lot of debate about when central banks should cut rates and at what pace they should cut rates, given that inflation still exceeds their policy target of kind of 2%. Obviously, here in Australia, that is a hot topic. And you would see sort of slightly divergent policy actually in terms of trying to hold rates, although Australia never raised rates to the same level of contraction that you saw in the United States. So you have to think of the US as having had more severely higher real rates than Australia. And you're starting to see those come back down. And we'll see what the give and take of those two policies are. But it feels like the US is about 6 months ahead in terms of defeating kind of inflation and being able to start lowering rates. And you'll see on the right-hand side this concept of implied market cuts, that I talked about earlier. If we go to the next slide, I want to talk about one major issue, and we'll probably get some Q&A about this. The elections are in focus for everyone. It's a coin flip. I think people have asked me. I've been in Australia for the last sort of week and a half, meeting with clients, talking about the trust, talking about private equity and things going on. It's very much a coin flip. There's a lot of different potentially volatile issues around the world, and I'll tell you, I think the trust itself and the underlying companies are pretty well positioned for all of those outcomes. If we go to the next slide, the markets, it's really a tale of two markets, and I think this is going to be very important when I talk about kind of private equity. For the last 2 years or so, things like the S&P 500, the MSCI, all world indices, they've done reasonably well, but it's been largely driven by a handful of large technology companies. And those technology companies have seen multiple expansion on the back of a kind of market sense that they are extremely well positioned for the AI investment boom, and then also for hopefully the capture of economic rents associated with, AI and that technology being rolled out and becoming part of society and productivity over the next 5, 10, 15 years. It really didn't have a huge impact on the rest of the market. What you've seen year to date, though, is kind of a change in that, which is the small caps and the mid caps, which are a lot more relevant from a size perspective and type of company perspective, have finally joined the rally. So if you looked at for example, the small cap indices in the US or mid cap indices, they're up north of 30% year to date. I would hope that over the course of the next 6, 12, 18 months, and it always happens with a lag, that you'll start to see the carry through of some of that rebound in valuation and multiple expansion in those style and size of companies, also feeding through to the PE1 trust and the private equity enterprises that we own. If we go to the next slide, if you look here, just entry multiples for private equity, this I think is the key. So if you look at 2021 and 2022, multiples sort of peaked, during that period of time. If you looked at 2023 towards the end of the year, they got down to kind of the lowest they've been since 2018. I think if you looked, this is all buyouts, by the way. If you looked at sort of a middle market space, average transaction was happening, it was even more stark than that. Meaning the multiples and the absolute peak of late 21 and early 22 got up to almost 12 or 13 times. And if you looked at late last year, they got down to about 10 times. And so you've seen almost 20, 25% contraction in the multiple on earnings before interest, taxes, and depreciation, for most of the companies. At the same time, the cash flows grew. So you didn't see the NAV decline overall, but you saw it go sideways. That kind of explains that period. The good news is rates have started to come down and people started to price those rates coming down. The multiples are returning to a middling place, kind of a historically middling place, which is about 11 times, 11 and a half times. And we're starting to see that. You could see here the first half of 2024, the multiples started ticking back up. And I can tell you as of today, things are getting done in that 11 to 11 and a half times multiple range, which, considering the companies are still performing very well, you should get the benefit of both performance in the underlying company and growth, as well as the multiple expansion. If we go to the next slide, quickly, the other side of this, so that's sort of price, meaning there are good reasons to believe that the things that have been headwinds are now tailwinds from a valuation perspective. From a deal flow perspective, you can see that 2021 was an anomalously active year. If you look at this graph, the solid line is the deal count by number, and then the bars are the value, dollar value of the deals. And you'll see that 2021 was frenetically busy. It was kind of a frothy market. 2022 and 2023, there was a real slowdown. And then 2024 is now on pace to exceed 2023's volume. So you're starting to see a recovery in activity. There was a real separation between the expectations and desires of buyers and sellers for a while, right? If you owned a really nice private equity enterprise, you didn't feel a need to sell it while earnings were growing 10% per annum, and you felt pretty good about your investment. And buyers reasonably, in a high rate environment, were expecting higher returns on capital and lower multiples. You really didn't have a lot of transaction activity for a while. That's starting to return as people agree a middling place, a middling price, reasonable expectations on both sides. You're starting to get transactions coming back. If we skip ahead to slide 12, the portfolio itself is now fully invested. So if you think back to the trust launch in 2019, we really had 100% cash, and that cash wasn't really earning anything. And we had a plan to deploy that capital pretty judiciously over a multi-year period in a number of different ways, whether that be equity investments and co-investments, private credit, etc. We've now got the trust fully invested. As you can see from this graphic, there's only 1% in cash. The underlying represents over 500 companies. So this is one of the most diversified private equity portfolios that we run across our $80 billion plus GCM asset base. It's been diversified by vintage, by geography, by sector, by style. There really is no variable by which we didn't sort of risk manage and construct the portfolio. I think of it as sort of part of the firmament of private equity. If we go to the next slide, just pretty quickly, this is the graphic just to show you what we've done since probably, if you go back a little over a year, June to June, you can see what I'm talking about in terms of finishing out kind of the investment and commitments across the fund. So we've added the last series of investments. Some of these were done as secondaries, for example. A lot of it was private credit. You'll see there's been a buildup in private credit. Some of that private credit actually lives in some of the other buckets there. So the actual look-through allocation to credit, the trust is probably up to about 10%, and I'll talk about that. That was zero when it was in a zero interest rate environment. We had a plan to build to 10% or so over time. We've managed to do that now. We did it during a pretty robust period there where yields on the private credit were much higher. And now we're enjoying those higher yields, even though they've started to back down. We're enjoying kind of 10, 11% yields across the portfolio. Skipping ahead to 14, just to give you a little bit of a sense, the underlying returns on every dollar that we've deployed into private equity from the date the trust was launched is 15% IRRs. So the internal rate of return on a dollar deployed has been about 15%. Obviously, there's cash that didn't earn that rate of return that blends together to a lower rate for the overall trust. But when we've deployed a dollar, that 15%, which is our target on a gross basis across the trust, we've been able to satisfy that. The multiple has been about 1.4 times, which is very good, during this period of time. We've diversified, as I said, by all the different styles of investment you can see on the left. In the center, we're obviously tilted to North America, that mainly being the United States and a little bit Europe. That fits our frame, both of globally where middle market private equity lives, as well as sort of where Grosvenor as as a asset manager is strongest in terms of capabilities. And then if you look on the right-hand side, you'll see we've been extremely careful about making sure that the portfolio by industry represents a diversified, cross-section of the economy. There is a tilt towards defensiveness. So I think what you would find, most of the companies in the trust have moats, they have pricing power, they're able to kind of withstand negative economic cycles and negative shocks, more so than the average, say, component of the MSCI world. And the reason for that is we've had a deliberate tilt. When you target a 15% return in private equity, we could have targeted 20, we could have targeted 25. We purposely tilted to a more conservative frame with more robust enterprises as part of this portfolio. And so you can see that on the right-hand side, how diversified it is by industry. If we skip to the 15, that's the NAV performance. So Mel mentioned this. As you can imagine, early in the life of the trust, it was cash and we were building out the portfolio. It experienced extreme asset growth during that 2021-2022 period, kind of commensurate with what I discussed in terms of the market conditions. It's gone sideways since kind of middle of 2022. That's as multiples contracted, but the cash flows in the companies grew and we built out the rest of the portfolio. And now we're in a condition where we're kind of fully invested and hopefully the long-term return of private equity, which has been mid to high teens, you'll start to see in the overall portfolio and enjoy it in completely because it's 100% invested. If we go to slide 16, I'm not going to read all of this. I think I covered most of it in terms of what we've been doing on the underlying investments. I will tell you, we're starting to have exits and a lot of different, successful realizations across the portfolio. Over the last couple of quarters, I think we've had almost 25 exits or 25 deals signed across the 500 companies. That is abnormally high. So a little bit in line with what I said about market activity coming back, we're starting to see realization activity in the portfolio come back in a good way. That's been happening typically at a premium to NAV, kind of 10, 15% premium to NAV, which is in line with what I said about the multiple expansion you're seeing. If there's a sort of one turn of multiple expansion or 1.5 turns of multiple expansion from 10 to 11 or 11.5, it would be reasonable to expect those types of outcomes, as long as the companies are performing well. The next slide, just top 10 holdings. I won't belabor all of these, but I get asked a lot of questions about, sort of some of the stories or what's going on in the portfolios. Where is there a lot of activity? A couple of these just of note, Lineage, which is the second largest position, is a cold storage business. This is distributed food, essential part of the kind of firmament of delivering food and grocery product across the United States and actually now other parts of the world. Lineage went public, and so it's successfully trading. We've had a nice multiple on that investment, and we've got a plan in line with the sponsor to sell down that position over kind of a 2 to 3 year basis. It's been really successful and we're happy with it. So it's a good example of an exit. Uber Freight, this position is being purchased back by Uber at a nice multiple on our invested capital. That should happen later this year. Blue Triton, I want to mention this one because I think the name probably doesn't mean anything to most people. This was a carve out of the bottled water business from a large European conglomerate. We bought the asset very cheaply, kind of multiple of earnings, sort of 5-6 times earnings. They were able to raise price by almost 18%, across the board during this period of time. They were able to rationalize costs. The sponsor's done an excellent job, and we've already had, kind of multiples on capital over a very short period of time. And they're in the process now of, kind of looking at a strategic acquisition of a comparable company that hopefully will be accretive and be the next phase of the plan execution for that company. Core Specialty is an insurance company. It's obviously probably everyone on this line knows that insurance premiums are going up globally more than inflation. It's been a hard market for insurance, meaning it's less competitive. Pricing has been robust. We've been taking advantage of that by deploying capital and participating in insurance markets. Core Specialty is part of that. It should go public later this year, as well. If we go to slide 18, just some performance versus benchmarks. I sort of talked about it. I won't read this across, but I think we're pretty pleased with how we measure across Burgess indices, which are kind of private equity indices across the top quartile, as well as pooled returns, as well as kind of global markets. Slide 19. I'm going to focus here, and then I'll probably wrap up, and then we'll start taking questions. Just people ask often, where are we focused? What are the sectors? If we're a little bit worried about being late cycle economically and we're being conservative, where do you go? The 5 core categories or sectors are up top. So consumer staples, Think of things like bottled water, things that are less likely to change in terms of volume, even in a negative economic condition. Financial services, particularly insurance, as I mentioned, is a hot area for us. And we've been, I think, ahead of the curve a little bit in deploying capital for the trust in that area. And we've been beneficiaries in the market conditions. Healthcare continues to be a good, stable place for private equity investment. There's a lot of rationalization that needs to happen in that area. There continues to be a need to improve the quality of care for customers, but it needs to be done at a price point and a level of efficiency that that can be delivered so that the service can be delivered in the right way across the United States, Europe, and other markets. We're active participants in that process. Information technology, these tend to be for us fairly, I'll call them boring businesses. So, I think people think of tech and they think about very exciting things. We do have a few of those in the portfolio. For example, SpaceX, as you would have seen in the top 10 holdings, is a holding, and that's fairly exciting for people to talk about. Most of what we're talking about in information technology, these are recurring revenue businesses where they're doing things like claims processing. We have a company that helps do claims processing for healthcare and other government programs in the United States. It's part of the real backbone of the provision of those services under long-term contracts. And the final category, government services. We and a private equity sponsor we work with have done a pretty good job of providing outsourced services to government, both in the United States, Europe, and in other markets on a consistent basis. They tend to have very long-term contracts. There tends to be a good return on equity if you do a good job managing those assets. And we continue to like that space. It doesn't have the upside of, kind of a brand new company or a venture capital enterprise or something else. But the idea of earning kind of a 15% plus return pretty consistently across the board while providing those services to the government where that the counterparty is going to be there come thick or thin in terms of demand, that's exciting to us. The only other thing I'll mention on this slide, my favorite, and I get asked this a lot, one of my favorite, transactions, what do I like to see? The family-owned business, middle market businesses continue to be the bread and butter of what we do. There are a lot of founders, there are a lot of families who build amazing businesses, with great moats and really happy customers and wonderful products. And they eventually need, for whatever reason, to bring in outside capital, either to grow those businesses or they need to dispose of those businesses to split the wealth, essentially, for, second generation, third generation, family members as it becomes more diffuse. We are a huge participant in that space. A lot of our private equity transactions come from that space, and we continue to be really active there. I think if you looked at a lot of our best transactions across the portfolio, there are founders who built amazing businesses, and we're really happy to provide capital to them in that space, and it continues to be the real driver of flow across what we do. So maybe with that, we can jump ahead to kind of the Q&A slide, and I'll turn it back to Melissa.
Thank you, Fred. That was a great update. We have had a few questions come through on the discount. Now, I will note Fred is obviously in charge of the underlying portfolio, and it is Pengana's job to manage that. But do you have any specific comments on the discount that you would like to see, Fred?
It's always a little bit hard for me. So if you think about what Grosvenor does, we manage 250 large institutional private equity portfolios, for insurance companies, sovereign wealth funds, et cetera. And we think of the trust in that context, meaning we manage this portfolio in the same way, trying to deliver that institutional quality experience. Most of the clients look at the IRR. Most of them look at the IRR of the portfolio. And if you saw mid-teens plus IRR in their private equity portfolio over time, they'd be really excited and they'd be holding and patient. Obviously, this is on market and people trade it on market. And so that's a different dynamic. I do agree with what Mel said earlier, which is the fact that the NAV's just gone sideways for 18 months or 2 years. I think for people, maybe if they had full knowledge of what I'm saying on the underlying dynamics in private equity, maybe they'd have a little patience around that. If they don't, maybe they don't have the same level of patience. And so, I think over time, given it's a fully invested portfolio, as we start seeing that compounded return from the underlying, I would hope that you'll get the appreciation in NAV, and then the appreciation in NAV will attract interest, and maybe it'll become a little bit of a larger play. The other thing I'll tell you is, look, not everyone's Warren Buffett, right? So a lot of people, he would tell you don't use the price action as a signal. Figure out what value is, and then make your own decisions, whether you think it's a good idea or a bad idea to purchase. There are definitely market participants who the price action itself is a signal. And I think that sometimes can cause, an overreaction both ways in public securities. Sometimes they're too rich, sometimes they're undervalued versus the kind of fundamentals. We couldn't recreate this portfolio probably even at par today, let alone at kind of 80 cents or 85 cents of par. So, I look at it from that perspective, and it's sort of it's an anomaly for us, but I hope over time, as long as we do what we said we were going to do and try and deliver on the private equity return stream, that it'll start to reconcile.
And I can definitely say I know a large number of our holders are very supportive of the vehicle and take that long-term view. It's just the outliers that can sometimes distort that price, unfortunately. I have another question. Is the private credit exposure through funds or direct loans made to companies?
Yeah, it's both. The answer is it's both. So there's a handful of funds, but most of it is through direct loans, into companies or, kind of direct credit transactions. Credit is a little bit difficult asset class to have a lot of fee leakage or economic leakage, which sometimes you can get with funds. And so we tend to do it a little bit more directly. And that portfolio, is over earning right now because of when we did it. We sort of put most of those investments in place over the last year or two. Rates were pretty high. They've come in a little bit. Spreads have come in a little bit. So, it was good timing. And then we'll have to decide what to do in 3 or 5 years in terms of reinvesting that capital and see what the market conditions are at that point.
And in terms of timing, 2024, what are your thoughts on this as a vintage through the cycle? Obviously, P1's heavily diversified across vintage, but do you see this as quite an opportunistic one?
I think the time, it's interesting. So there's always good and bad times to kind of deploy capital. 2021 turned out not to be a great time to deploy a lot of capital. 2022 and 2023 were pretty good. I think 2024 is middling. I think the market's actually kind of in balance, which is why you're starting to see reasonable amount of transaction activity. I think both buyers and sellers can do reasonably well, in the current market, and no one's doing, that favorably. If you looked at PE1 and the 500 companies, obviously they've been done over many different years. So there's not, particular time bias to anything that we're doing there. And incrementally, since it's fully invested, what will happen is as transactions happen and realizations happen, we'll just redeploy the capital over that period. So I don't think timing the markets in private equity works that much better than people trying to time public markets. I'm not sure who has that skill. And we haven't had a lot of success with it. We tend to be pretty methodical and just trying to deploy the money over time, and it tends to be a more reasonable way, at least for us, to stay invested.
Cool. Another question, could you comment on DPI?
Sure. I mean, it's a huge topical area. DPI, for anybody who's sort of not in the know technology, is really just talking about the distributions or the capital that's returned on the invested capital. If you read the Financial Times, probably been 10 Financial Times articles about how in private equity DPI is down over this. That's really all about deal activity. So there's a lot of dry powder, but the amount of sales was down over the last 2 years. And as a result, the return of capital from funds has been lower than what you would have expected during that period. As we start to see more transactions and that volume pick up, which we've already seen the first half of this year, if that continues, you'll start to see the DPI pick back up, in the funds. At the end of the day, a private equity fund is a finite in life vehicle, and they'll have to catch up by the end, if that makes sense. Like by the end of the 10-year period in a private equity vehicle, they have to return capital. So they could slow down for a period, but they can't, you can't avoid returning the capital and producing the return over a period of time. Also, the dry powder has a finite life. When people commit to a private equity fund, typically it's got a 5-year investment period. They can't wait forever either. And so it's a natural thing for the number of transactions, the dollar value of the transactions to come back. The DPI will start to take back up in all the funds.
Another question around realizations. In fact, there's two, so I'll bring them together. In terms of the end of the financial year 25, how many realizations are you expecting? And then on the realizations so far, we have seen the IPO market dry up a bit. So what are the course of sales? Where are they being realized?
Yeah, maybe I'll try and answer both. I don't have a specific figure on expected. I never do, right? Like meaning people, there's a lot of things that people are trying to sell, and then we'll see where the market kind of clears. It's looking good right now, but kind of like to see it. In terms of the channels of exit, there's really 3 main channels of exit. One is the public markets and the IPO market, and a lot of our larger positions are going public. I mean, that's a viable path right now, and a lot of them are. If you went through that top 10, some of those are public, some are the kind of you seeing that exit, but you have to be very large for that to make sense. The average middle market company, it doesn't make a lot of sense to go public, to $1 billion or $2 billion in the US. The second are sales to strategics. or kind of strategic transactions. That's been a little slower over the last 3 or 4 years just because it's been a relatively difficult environment for getting deals done in the US and getting them approved. So, from a mergers and acquisitions perspective, the Biden administration has been pretty negative on consolidation and that type of activity. We'll have to see after the election whether that changes. It could liberalize a little bit, and you might see a lot of deal activity, but you haven't seen that much. Like, it's difficult, for example, for like Microsoft to buy a small software company right now, even if in the past they would have been a natural acquirer of that product and added to the product suite, that type of thing. And then the third channel, which is where almost all the exits happen, are sales to larger funds. So when we live in the middle market space in private equity and we buy enterprises for $500 million and we grow the cash flows and get a multiple of 2 or 3x, they turn into billion to $1.5 billion funds. That's the exact right size for the next tier up of private equity managers, right? So if you think of the lower mega cap funds or mega cap funds, they're the natural acquirers, and they have a different game plan for the assets, in terms of being able to realize, and each part of the ecosystem is able to kind of execute their plan for those assets. And so that natural transition is really where most of the middle market assets go. They get to enough scale that they become upper middle market or lower mega cap, and they get transitioned essentially to the larger private equity, houses at that point in time. And that continues. That's where most of the sales are.
We are at time, so just maybe one more question. In terms of the makeup of the portfolio, we do have over 500 underlying companies, but we are seeing that some of the weightings in the top 10 is creeping up to sort of the 4% mark. Any comments on that at all in terms of concentration?
Yeah, I mean, all of those would have started at sort of 1% or sub 1%. And so to become a top 10 position in a 500 portfolio company, you really have to be successful. And a lot of those are towards the end of their life, in a lot of those cases, meaning they're in the process of going public, they're in the process of being sold, they're in the process of realization. So it makes sense that they would take up to like 2 or 3% positions. The only anomalous one, things like the SpaceX is on there as kind of a 4.6% position. It's done very well from a multiples perspective. We'll have to start risk managing it down. I don't think it's going public anytime soon, but we'll have to start risk managing that, down to a reasonable size, probably over a period of time. Like, it won't take care of itself naturally, but the others I think will take care of themselves naturally, through the disposition and exit process. I think 3 of them are public and a bunch of them are going public, and we have disposition plans. We don't hold the shares forever. So it's sort of typically within the first 3 years after it's gone public, we will pretty methodically monetize those assets, maybe even faster. And so that capital will come back to the trust, and we'll invest in a bunch of 50 basis points or smaller positions and hope that they grow to be 3 or 4% because they were successful.
Awesome. I think we are at time. Thank you so much for your time today, Fred. I always enjoy your update. If you have any more questions on PE1, please reach out to your local BDM. More than happy to help. And we will also send a copy of the slides and recording. But in the meantime, have a great day. Thank you.